Bank loans, also known as senior loans or leverage loans, represent a compelling opportunity for fixed income investors, especially in today's interest rate environment. There are three key reasons. First is that bank loans have floating rates. So in periods of rising rates, they offer low duration or interest rate sensitivity. A second investor benefit is yield. Bank loans tend to provide attractive yields on par with high yield bonds, but with lower volatility and higher seniority in the capital structure. And third, when considering the rest of your portfolio, loans can be a powerful diversifier due to their low historical correlation to traditional fixed income categories and their relatively high correlation to inflation. So these are some of the reasons that adding a long-term allocation to loans in the context of a traditional bond portfolio can provide important defensive benefits, as well as potentially deliver attractive returns. Now let's dive a bit deeper into each of these benefits. First, the role as a defense against rising rates. Periods of rising rates are thought to be one of the more pernicious environments for fixed income securities. Bank loans are one of the few categories of fixed income for which that statement is the opposite. The coupon on a senior loan tends to adjust upward with interest rates floating with a spread above LIBOR or SOFR. You can see a marked difference in core bonds and loans when you compare their performance in rising rate environments. In almost all historical rising rate periods, the broader bond market has suffered while loans have outperformed. This typically happens when the economy is growing and the Fed is taking steps to cool things off, like in the taper tantrum of 2013 or more recently, the summer of 2017. With the Fed again engaged in raising rates, loans have outperformed other areas of fixed income. It's then that the inclusion of loans can have a countervailing impact, a defense against the effects of rising rates on the overall portfolio. Another key benefit to loans is the appeal of a higher yielding component in the bond portfolio. Income is one of the distinguishing characteristics of the bond portfolio, and that search for yield has been persistent over the last decade when rates had been at rock bottom levels. The income or yield benefit of loans has clear appeal, and not just during rising rate periods. Over the long term, in both rising and falling rate periods, they have delivered yield in line with high yield bonds, but with important differences from high yield, which as a category has a duration of over 4 years. That brings us to the final point, diversification, and the portfolio impact that the inclusion of loans can have. In addition to their other benefits, loans have low correlation, in fact, negative correlation to core bonds proxied by the aggregate index, as well as most components of the bond portfolio, from treasuries to mortgages to investment-grade corporates. That correlation is quite low. Interestingly, loans also have a higher correlation to consumer price inflation, or CPI, than most other fixed income categories. This double-barrel diversifying impact makes loans a particularly effective additive to the broader bond portfolio when incorporated at a strategic level across the allocation.